The US dollar, the unchallenged king of global trade for over half a century, has now entered the final, most precarious chapters of its reign, Stage 6 and Stage 7 of the classic currency collapse cycle. This is not unprecedented fear-mongering. This is history repeating, charting a path alarmingly similar to the one the British pound sterling followed from
1945 to 1967, as its own empire of money faded.
We stand at a critical inflection point, and if the undeniable economic patterns hold true, the next decade is not merely going to be transformative, is going to fundamentally reshape the world's financial architecture. Why is the dollar replicating Britain's decline almost step by step, and what truly happens in Stage 6 and Stage 7? Crucially, how close are we to the final, irreversible break? This isn't speculation. It's a meticulous analysis built on math, history, and unmistakable pattern recognition. In the following minutes, we will unlock the complete collapse timeline. Explain why the 10-year window from 2025 to 2035 is crucial, and detail exactly what the world could look like once the dollar's dominance becomes a memory. To understand the severity of the current situation, we must first quickly review the 7 immutable stages of a reserve currency's decline. These stages move sequentially, beginning with small fiscal sins and ending with a catastrophic loss of global trust. We are now transitioning sharply between Stage 6, characterized by widespread loss of confidence, aggressive international decoupling, and peak domestic debt. In Stage 7, which is the final, inescapable stage of the formal currency reset, or devaluation, it is a slow-motion car crash that only accelerates as trust evaporates. Compare this to Britain's post-World War II position, an empire saddled with crippling debt, depleted gold reserves, and a world no longer dependent on its financial mechanisms. The similarities are chilling, marking the dollar's current position as a near-perfect historical echo. Let us look closely at the British collapse blueprint between 1945 and 1967. After its victory, Britain found itself globally indebted, its post-war debt exploding to well over 200% of its GDP, a debt load that made maintaining its global commitments impossible. The consequence was the systematic loss of its global reserve currency status, not in one moment, but over 2 decades of painful financial maneuvering. This era was defined by failed attempts to maintain currency pegs and repeated humiliating devaluations, culminating in the major sterling crisis of 1949, where the pound was forced to lose a staggering 1/3 of its value against the dollar overnight. That was the moment the world knew the financial empire had fallen. Today, the United States is replicating the same essential economic fractures. A commitment to global power without the fiscal solvency to back it up, leading to a deep structural instability. The dollar in 2025 already exhibits the unmistakable signs of Stage 6 decline. The national debt is surging past levels previously considered politically and fiscally suicidal, breaching unsustainable thresholds with no plan for meaningful reduction. This translates directly into weakening, almost palpable, global trust in U.S. Treasury bonds, the very foundation of the dollar's power. Simultaneously, the de-dollarization movement is gaining serious, measurable momentum. We see major nations, particularly BRICS members, but also powers across Africa and the Middle East, actively and deliberately reducing their dollar reserves. Furthermore, the rise of alternative trade settlement mechanisms, utilizing the yuan, the rupee, and increasingly physical gold, is bypassing the dollar entirely. This growing economic fragmentation, exacerbated by increasing geopolitical stress, is pushing the global system toward de-dollarization at a rate few would have predicted just 5 years ago. Stage 7, the final break, is the phase we are hurtling toward. This occurs when the world no longer needs dollars to conduct essential trade, marking the end of the dollar's exorbitant privilege. The critical component of this privilege is the petrodollar system, and its potential breakup would mean America would suddenly have to earn dollars, rather than simply print them, to buy oil and other global commodities. This final break is being actively discussed, not just by critics, but within formal bodies like the IMF and G20, which are quietly mapping out scenarios for a new, multipolar reserve alternative. The loss of privilege means a higher inflation environment for Americans, significantly higher borrowing costs for the government, and domestic economic pain. The potential U.S. government responses to this crisis could include desperate measures such as the introduction of capital controls, a formal currency reset to wipe out debt liabilities, or the swift mandated introduction of a central bank digital currency. The dollar's replacement will not happen in a single day, but through the slow, irreversible erosion of global utility, culminating in the official recognition of a new financial reality. The 2025 to 2035 timeline fits this historical collapse sequence with shocking precision. We anticipate that between 2025 and 2027, the dollar's share of global reserves will drop below a critical psychological and operational threshold, forcing central banks to rethink their allocations. From 2028 to 2030, we expect to see a profound, accelerated global shift toward multi-currency trade settlements, effectively marginalizing the dollar. The period between 2030 and 2032 is likely to see dollar inflation spike severely as the consequences of chronic government deficits and higher borrowing costs hit home. Finally, between 2033 and 2035, the conditions will be set for a formal or informal devaluation event, mirroring the final agonizing years of the British pound. This two-decade decline timeline, 1945 to 1967 for Britain and 2015-2035 for the U.S., is a historical parallel that cannot be ignored. The most critical question for every individual is the impact of this transition on ordinary life. The weakening dollar translates directly into higher import costs, meaning everything from essential technology and certain foods to energy itself will become demonstrably more expensive. This leads to an undeniable decline in middle-class purchasing power, the silent tax of currency devaluation. Domestically, expect rising interest rates to continue to pressure the housing market and loan availability, making debt a significantly heavier burden. Job markets will shift as multinational companies move their operations and trade flows away from dollar-dominated jurisdictions. The effect on savings and retirement accounts held purely in dollar-denominated assets will be a slow, quiet erosion of security and future value. The time for panic is over. The time for preparation is now. Smart individuals must pivot from fear to calculated action. The primary strategy is diversification into assets that are not intrinsically tied to the political and fiscal strength of the U.S. dollar, whether that means select commodities, non-dollar denominated international equities, or precious metals. It is vital to develop a basic understanding of global currencies and trade flows, paying close attention to political shifts, particularly the developments within the BRICS framework. Ultimately, it's about long-term wealth preservation strategies that accept the coming reality of a multipolar financial world. Currencies do not last forever, not even reserve currencies. The dollar is not scheduled to die tomorrow, but the timeline for its dominance to end is unfolding exactly as history suggests it should. Following the same painful, multi-decade path Britain trod, if global central banks, sovereign wealth funds, and rival nations are actively preparing for what comes after the dollar, every informed citizen should be taking steps to secure their financial future. In our next analysis, we will break down the top 5 assets historically utilized to survive reserve currency collapses in, which one may dominate the wealth preservation landscape of the 2030s,